You are listening to Keystone's Stock Talk Show, episode 308. It's great to chat with you again. This week, we kick off the festivities with a small piece on boring, beautiful dividend growth stock investing in the face of rising investor enthusiasm. In your Stock Our Take segment, Brennan looks at FuboTV Inc., symbol FUBO on the New York Stock Exchange, a sports-focused streaming service that provides a comprehensive alternative to traditional cable, offering subscribers a wide range of live and on-demand sports, news, and entertainment content. Sounds like a promo for the company. A listener wants you to know wants to know from us if his beloved streaming service could be a good investment. Brett answers a viewer question on Mullen Group, symbol MTL, on the Toronto Stock Exchange, an acquisitive transportation and a logistics company with a strong 5.6% dividend, but weaker year-to-date performance. Brett lets you know if the stock provides value with growth currently. All right, let's get to the show. I'm going to welcome my co-hosts, the Killer Bees, Brett and Brennan. How you guys doing? Good
doing
weekend?
Well. Doing good, yeah.
Anything interesting? Anything new?
I helped my girlfriend set up her grade 1 classroom, so that was thrilling.
How was that? Yeah.
It was good. I haven't been in a classroom in years, but it felt fitting because
you haven't been in, but you peeped in the windows often, right? Like that's what you do as a pastime sometimes, right?
But I thought it was funny because we went and picked up Tim Hortons before we went to go set up her classroom. So, there's her and I sitting in these tiny little chairs with my knees basically touching my chin, eating Tim Hortons.
it was felt funny. Good about it.
Oh yeah.
Did it take you back?
It brought
the hallways,
me back.
Every time you go back, the hallways look so small compared to what, like in elementary school,
For sure.
Compared to what you remember. It's crazy. Yeah. No, this morning, actually, it's first day of school. So we took my daughter to school for the first day. So that's crazy. It's always like an hour day. It's not a long day, but tomorrow they get right back into it. She gets her actual teacher tomorrow. She went in with her last year's teacher. So she's excited about this year's teacher. Everybody's pumped, and she's got a friend over now. Should be fun. I'm sure they're having a good time.
Awesome.
All right, well, let's get in. We didn't have a poll question this week. We'll have a great one coming up next week. We had our live webinars last week sold out, which is great to see. If you want to access those, you go to www.keystocks.com. There'll be an on-demand version of those available there. We give you 6 to 7 stocks that you can buy today in your portfolio and talk about how to find the next 10x stock. Brennan goes through a bunch of stuff. What were you excited to present this year?
My favorite thing is the case studies on when to take profit, or looking fundamentally, should we be even though we recommended this business and it's up maybe 100%, should we be taking profit, or maybe, does the valuation and growth prospects still look good in the business? I really like, going through these case studies. I've got 4 of them. So I think that's fun and interactive kind of, it's probably my favorite piece, but as well.
I was going to say, it's so important to have actual case studies, looking at, what we've done successfully in the past, maybe what we don't want to do again, that we've done in the past, and continue to learn from that going forward.
Yeah,
and of course,
how
presenting
you look at it.
The companies is always interesting. New buy recommendations.
And then as well, because I'm a big philosophy nerd, I love bringing in some stoicism into some stoicism and Warren Buffett and Peter Lynch quotes into my segments, because those are 2 guys that I think really, really did well or have done well because of their stoic approach to the market, where Mr. Market will do what Mr. Market wants to do, but at the end of the day, buying these quality businesses will pay off in the long run.
Yeah. And you go through one section that goes through how we do our research, and you've coined it leaving no stone unturned. And that's kind of what around the office, what we talk about is just looking where, others don't look, and just leaving no stone unturned. And presenting those companies. And the thing at the end that we always do is we do a Q&A, and we had 35 minutes. We ended up with too many questions, so we ended up answering some after on email. But yeah, those are great, those open sessions where we are sitting in there answering any and all of the webinar attendees' questions.
Yep.
It's usually fun. There's some great questions and then always some less great questions, but both of them are fun, right? So you never know what's going to be said, right? So it's always interesting. It's always good. All right, we might as well get directly to my segment here. This week, I'm going to look at the power of boring investing and the case for dividend growth stocks. Now, it seems to me that for most, even new and a lot of old investors, they want excitement in the market. Well, fortunately for them, meme stocks are back. Does anybody know where this came from? Anybody?
Twitter. Just kidding.
True Detective. It's from True Detective. It's the first season, the best season. Watch it. All right, that's all I'll do. So memes are back, as you can see there, and so are SPACs, and the return of the SPAC king, Chamath. I'm gonna bastardize his last name if I say it, so I'm not going to say it, who built a large public following through social media and media appearances where he promoted these companies with great enthusiasm. He was seen by many as a champion of the retail investor, not so much. When the stocks collapsed, his response famously telling investors, "There's no crying in the casinos." This was perceived as dismissive and insensitive, pretty much is. Many investors felt he used his platform to hype speculative and money-losing companies, then walked away with his profits while they suffered the losses. Now, Chamath backed not today's, but his past Chamath backed or involved specs included Virgin Galactic, down 95%, Open Door, down 95%, Clover Health, the big winner here, down 90%, and both Proterra and Sun Life Financial, which filed both for bankruptcy. But he's back. Chamath, after a period of relative quiet in the SPAC market, has launched a new SPAC called American Exceptionalism Acquisition Corp A. Here's a breakdown of the SPAC, a new $250 million SPAC that filed for an IPO. It'll file this week, I believe. It plans to trade on the New York Stock Exchange under a ticker symbol that I'm not aware of, but might as well just be called SPAC crap. This SPAC focuses on companies in areas that Chamath believes are critical for American leadership. We might agree with this, but it's artificial intelligence, decentralized finance or DeFi, defense technologies, and energy production. And history is probably set to repeat itself. Now, in the fun times, Robinhood, the upstart online brokerage, even managed to turn investing into a video game with mysterious rewards and digital confetti to celebrate your trades. When fun is fun, well, when it's fun, it's fun until it's not. The music stops, your seat is removed, prices fall, and that fun turns into regret. Recall the NFT craze in 2021. People were paying millions of dollars for images of lazy-looking, disenfranchised apes. Since then, Bored Ape Yacht Club NFTs have crashed 90% from their all-time highs to levels seen before the NFT hype boom began in 2021. And the entire market is much less active for NFTs. Robinhood, of course, got fined for that digital confetti. And yet boring investors, not boring apes, keep winning without ups and downs. Take Warren Buffett. His best investments aren't new tech or AI. They're Coca-Cola, railroads, credit cards, and Apple, which he brought Apple after the iPhone came out. Apple was not considered exciting then at all. He makes nearly $4.5 billion in dividends every single year, whether the market goes up or down. That is the power of dividend growth investing. It's not exciting, but it works. Now, let me give you a couple examples from our research. We see here from KeyStone's Canadian Dividend Growth Stock Research, Brookfield Infrastructure, recommended in March 2011 at $9.91. As of August, early September, it has paid approximately $25.86 in dividends per unit. Again, recommended at $9.91. It's paid us $25.86 in dividends, resulting in a total return of 594%. From our Canadian small cap growth stock research, another dividend grower that has produced both astonishing dividend and price appreciation in a short period of time, 5 years. That company, Hammond Power Solutions, HPS.A on the TSX, recommended as a buy, $6 in March of 2020. As of early September, Hammond Power has paid $3.69 in dividends per share, and the dividend has increased approximately 223.5% from March 2020 to March till this year. This has increased. This has resulted in a total return of 1,930%. Companies like Johnson & Johnson, Procter & Gamble, Chevron, these companies won't double next month, but they've paid and increased their dividends for decades. Every 3 months, they pay you. And every year, they increase that payment. Small steps, but over time, they compound into freedom. Exciting investing is expensive. Buffett recently wrote, for whatever reasons, markets now exhibit far more casino-like behavior than they did when I was young. The casino now resides in many homes and daily tempts the occupants. Investing should be more like watching paint dry or watching grass grow. If you want excitement, take $800 and go to Las Vegas. That came from Paul Samuelson. Samuelson knows that you pay for excitement in investing. And he's right. NFTs, crypto, meme stocks, most crashed. Dividend growth stocks just keep paying you. Boring is beautiful. Dividend investing doesn't just grow your wealth, it also protects your peace of mind. When the market crashes, you don't have to panic. You don't have to watch your portfolio or the news 24/7. You know those dividend checks are still coming because people will still buy toilet paper, Coke, gasoline, and groceries. You'll still need transformers in buildings, and they'll use credit cards to pay for all this. You can sleep at night. Boring works. So if your portfolio feels boring, you're probably doing something right. And there's our disclosures, Hammond Power and Brookfield Infrastructure.
Yeah. I guess that's something as well that I could have elaborated on that I'm looking forward to, presenting, is just looking at, the effective yield and dividend growth stocks and how powerful it can be in your portfolio. That's another segment that I did in the webinar here. And like Ryan touched on, I'm pretty sure on Warren Buffett's original investment in like 1970 that he made, I believe his effective yield on Coca-Cola is now over 50%.
Yeah.
He's earning 50% a year on his initial investment every single year. And that will continue to grow as long as Coca-Cola continues to grow their dividend. It just shows
if you look
power.
At Hammond Power, the effective yield on that just since 2020, if you would have bought then, the effective yield is over 18%. Yep. So whether that stock goes up and down for our clients that are bought at that point in 2020, they're getting paid 18% plus a year. It has gone up, obviously, which is nice to see, but you start to get that yield and it's going to, we expect that dividend can grow again this year, right? It compounds on itself over time, which is great to see.
Yeah, as well. Like I'd also mentioned just like on like the Bored Ape Yacht Club, I think like at the peak of that, I remember like Justin Bieber, I think it was like something upwards of $1 million he paid for this NFT. I think that, like that NFT, like don't quote me on this, but I think that NFT is worth like, $50,000 today or something like that. Destruction of capital. I remember
one of Bieber's best investments still.
One of Bieber's best investments.
Sad things.
I remember my cousin, during like 2021 when everybody and their dog was, getting a investing or a self-directed brokerage platform, and my cousin told me, "Hey, you got to check out this Virgin Galactic Space SPCE." It was then trading at a couple, $300 per share. think it's trading at, $4 per share today. Again, fundamentals are like gravity. We talk about it all the time, but it's something that you need to focus on in your portfolio.
Yeah, those SPACs from Chamath were just this. He was involved in. I mean, this SPAC is supposed to be different. He doesn't, they vest over time the shares, but they got like founder shares or whatever you want to call them in those investments, and they just cashed out as they went higher. I mean, that was an opinion here, but it, closer to white collar crime than anything else. But I'm sure all the disclosures were there saying that your money's completely at risk, but it was fairly gross.
Yes, you're saying SPACs are back, but it's compared to the 2021 period. So there was 84 SPACs so far this year that have IPO'd. How many do you think were in 2021?
200.
Higher. You got
7 million. No, okay.
A bit lower than that. Chamath might have wanted that way.
1,000?
600.
600, yeah, 613.
Oh, nice. Okay.
So
I think because I was commenting on SPACs that I think that kind of starts to ring a bell. But crazy, yeah, they're not back. No, definitely.
You could see them just start to. None of them could buy any private companies in the following years. So the SPAC funds
went back,
slowly drained out. They went back to the initial investors at that $10 a share price. Which that's why you always see. If you see these companies that are called Acquisition Corp, or it'll be like Biopharma 3 or something, those are SPACs, just so you are aware, because we will get occasional questions, what is this? They're almost always named in that manner. So if you do see something, trade around $10 a share.
Yeah, looking like to buy a company is what they're doing.
Exactly. And all they're doing is looking to actually find something to buy. They have nothing of value past a pile of cash in them at the time. And normally, like Ryan has went through, they lose a lot of money. This is just pulling off the same website, SPAC Insider. The worst returning sector, minus 97.6% cannabis. Just throw that one out there because I know that's something we've talked about before.
Yeah.
All right. Well, let's move on from. That segment just shows you boring is beautiful over time. People want sexy, but you can also get sexy. I mean, Hammond Power is not only just sexy, but boring. It's like you got both of them in one. So, I mean, you can marry those two, particularly when you're looking at like many of these small cap companies we look at also have growing dividends. So it's not just your stodgy old Chevrons of the world that can pay a dividend growth stock. There are smaller, cash-rich businesses growing at well above average rates that grow their dividend, grow their share price over time. That can be a great marriage in investing. You got a dividend growth stock, small cap, and good growth in the underlying business. I mean, the only way you grow your dividend over time is if the business is growing. So it's makes sense how those things compare together.
Exactly. Last thing that I'll say too, just on that is I make a comparison between Barrick and Dynacor. If you're a listener to this podcast, you should be familiar with Dynacor. But I have a 100% true story of being on the golf course with one of my friends, and I pitch him Dynacor, and he comes back to me and says, "I only touch the big boys in the gold sector." And I do again a little case study looking back, at 5 years, and just show the power of a cash flow compounding machine compared to not. Anyways.
Yeah. Excellent. All right, let's move on. The next segment, Brennan's going to look at. What are you looking at this week, Brennan?
I'm looking at that Fubo TV.
SPAC King. I'm just kidding. What?
I'm looking at Fubo.
Yeah, you're looking at Fubo or whatever.
Fubo
TV. Have you ever watched it?
I haven't. No. I've heard of it before, but yeah. So we got an email from Michael, and he says the company gapped up from $1.50 to $4. What are your thoughts? So FuboTV Inc, FUBO, on the New York Stock Exchange, currently trading at a price of about $3.71, about a $1.2 billion market cap. They do not pay a dividend, and essentially they provide a sports-first pay TV replacement product. For offering subscribers access to tens of thousands of live sporting events annually, as well as leading news and entertainment content, both live and on demand. A majority of the business's revenue comes from its subscription services. So, as Michael notes, the stock did gap up from $1.50 to approximately $4 in January following the news that FuboTV ended its antitrust lawsuit against Disney, Fox, and Warner Bros., which is essentially just Discovery, and that the Walt Disney Company entered into a definitive agreement for Disney to combine its Hulu Plus live TV business with Fubo, forming a combined virtual multi-channel video programming distributor company. And under the terms of the definitive agreement, Disney will own approximately 70% of Fubo, and Fubo will continue to operate under its existing management team. Now, regarding the litigation, Fubo settled with Disney and ESPN related to Venue Sports, the previously announced sports streaming platform planned by ESPN, Fox, and Warner Bros. In connection therewith, at signing of the transaction, Disney, Fox, and Warner Bros. Will make an aggregate cash payment to Fubo of $220 million, and Disney has committed to provide a $145 million term loan to Fubo in 2026 as part of the transaction. So that's why the stock was essentially up, and the Fubo TV merger proxy meeting is scheduled for September 30th of 2025, so just a few weeks from now. So shareholders as of record on August 6th will be eligible to vote on the business combination agreement in September here. Now, looking at the last quarter ended June 30th, 2025, revenue was down 3% year over year, and there was 1.356 million paid subscribers, which was down 6.5% year over year. Net loss from continuing operations in the second quarter was $8 million, or a loss of 2 cents per share. This compares to a net loss from continuing operations of about 25 or 26 million, or an EPS loss of 8 cents in Q2 of 2024. Now, adjusted EBITDA was positive 20.7 million, representing the company's first positive quarter of adjusted EBITDA, and free cash flow was a loss of 37.7 million. Now, if we look a little longer term on a quarterly basis, we can see that operating income, net income, EBITDA, and cash flow have been negative for the majority of the time. But the last quarter does appear to be a decent improvement. I'll also note that in Q1 2025, ended March of 2025, the large gain in net income as well as cash flow was actually due to a gain on that settlement of litigation, which boosted earnings. That $220 million payment I referred to earlier. And looking at the most recent quarter, the company did have net debt of 91 million, and its share count was now up to 342 million shares outstanding, up from 311 million shares at the same period last year. And because the company has negative trailing EBITDA, we cannot calculate its trailing net debt to EBITDA multiple on the business. So clearly here, the company has been issuing shares to keep operations afloat. And just to show, again, EBITDA and free cash flow were both negative over the past trailing 12 months. Here's the valuations. Just quickly looking at the valuations, if we adjust out the gain from the litigation, all of its valuation metrics are negative on an earnings basis and cash flow, given its lack of earnings and cash flow. So, looking just on a trailing price to sales multiple, the business currently trades at just 0.7 times sales. And to conclude here, so the reason the stock gapped up in January from $1.50 to $4 was due to the end of its antitrust lawsuit against Disney, Fox, and Warner Bros. Plus, the Walt Disney Company entered into a definitive agreement for Disney to combine its Hulu Plus live TV business with Fubo, forming a new entity there. Now, financially, the business hasn't been really performing that great. Top line revenue growth has been there, but there's really been no real profitability in cash flow. Although there was positive adjusted EBITDA in Q2 2025, which is decent, the trend in profitability hasn't been that great. Plus, again, the business is in a net debt position and rapidly has been increasing its share count given the lack of profitability. Now, the new entity with Disney owning 70% may be intriguing, but it's tough to know what the business's forward fundamentals will look like. If someone asked me if the deal wasn't possibly coming down the pipe, would I invest in Fubo? I would say no, as the fundamentals are relatively lackluster in my opinion, with no profitability, further dilution, net debt balance sheet, just things that we don't love to see. So, we'll see how the vote goes in late September for approval of the merger. I think that there's, speculative potential for the new entity. But again, it's tough to tell how the forward fundamentals will look, and risk is certainly high. It's not something that I would personally be betting my own dollars on. And here is disclosure.
Yeah, and anytime we see a company like this where you're betting on something in the future and being able to integrate and being able to be profitable under that, you're always putting that next to what else can you put your investment dollars in. There's always alternatives. And when we can see businesses that have good current fundamentals, good current balance sheet, and the same amount of potential upside or similar upside or even greater upside, that's not to say that this company isn't potentially a decent speculation. It's just to say that we can invest in a company that has less downside likely and the same type of or more upside. And that's what we're looking for, because it's not about just finding companies with upside. It's about finding companies with less downside too. So, and in this case, there's a lot more speculation here than we would be comfortable with investing or telling our clients to invest in at this point. Again, doesn't mean this is a terrible investing or company to invest in. It just means we think there's too much risk for the potential reward. You can find less risk for the same commensurate or higher reward. That's what we're looking at. All right, let's move on. Brett's going to take a quick look at Mullen Group. They're an acquisitive transportation company, logistics company, been around for quite a while, and the 5.6% dividend. But as with many in the transport sector, a little weaker this year.
Yeah, the dividend's actually 6.1, a bit higher.
Oh, 6.1.
Yeah, 6.1.
I'm underselling them.
You're underselling it. And that's really what their selling
Under
point
promise,
has been.
now we're over delivering. That's what we're trying to do.
With a 6.1%. Yeah. So Mullen Group, symbol MTL on the TSX, is an acquisitive transportation and logistics company. The company breaks its operations into less than a truckload, logistics and warehousing, specialized in industrial, which is out of the company's legacy oil services, and U.S. and international logistics segments. The stock is trading at $13.72 a share. That is a $1.2 billion market cap and a 6.1% dividend yield. The stock has been a relatively consistent dividend payer and grower since it transformed in its more current form about a decade ago. And that's really the selling point of it for any investor, is the dividend growth of it in the long term and the income and the share repurchases. So zooming out though, the stock price just has been rather stagnant since its COVID recovery, really trading around that $12 to $14 range, with a bit of volatility in 2025 with Q4 earnings and the general tariff and trade situation, falling roughly 5.8% year to date. So negative return so far this year, but it's been relatively flat for about 5 years now, or 4 years. So it's worth looking into if the market just hasn't been considering it during this time. But high level, long-term financials, we can see why the company is just not seen considerable stock price movements over the past 4 or so years, since the financials have been really quite flat as far as revenue goes. EPS, it shot up around the time we did the last segment in 2022 on the last coverage on the podcast, at least. And then on the EPS side, we seen a general decline as margins have been pressured during this time and revenue has been that relatively flat range during this period. The company actually did benefit during the 2022 period from that inflationary environment, which was the headlines at the time. And that's obviously just not been the case anymore. We're now seeing lower inflation, slower economic scenario. Let's really get into the last quarter to see what's happening with the business. Revenue did actually grow in the last quarter by 9.1% to $541 million, but that's driven purely by acquisition of the Coal Group, which was completed during the quarter. And it only contributed 1 month of financials, but organic revenue actually fell 1.5% for the year. So it's purely acquisitive growth, inorganic growth for the revenue line. Adjusted operating income before depreciation and amortization, which you can just think of like EBITDA effectively. There's a bit of a difference, but not significantly. Fell 2.1% to $83.8 million, having margins contract to 15.5% from 17.3%. So margins did contract due to additional cost pressures, which they just couldn't be passed on to customers, which we are seeing in some places where costs have risen with like the tariff situation. We're seeing some of those companies pass on costs quite well and be able to maintain the margins. That's not the case with Mullen. As well as they did note a competitive pricing environment. As well, management is continuing to expect relatively flat revenue and slightly lower margins on an aggregate basis, excluding the positive impact from coal during this year. Diluted EPS fell 22% to 28 cents a share from 36 cents, and net operating cash flow, that is per share, fell 2.2% to 89 cents from 91 cents. So relatively flat there as well. Looking at the growth driver and likely the star of the year, the acquisition of Coal Group, a previously private company which closed on June 1st after about a 2-month delay, and it is an asset-light business model focusing on custom brokerage, freight forwarding, and third-party logistics or 3PL. The company is a strategic fit for Mullen as it builds out the asset-light logistics and the entire mile service. So that's where you're seeing it fit into the business. And it will go into Mullen's logistic and warehousing segment and the U.S. international logistics segment as well. It's quite actually timely, I would say, given the recent shifts in the supply chain with the U.S. trade shenanigans. So logistics are becoming increasingly complex. So this is actually quite an interesting acquisition during the period. The company was acquired for $190 million in cash, which was funded by Mullen's credit facility, but that was subsequently cleared out by a private placement debt offering. So they bought it on credit, switched up to long-term debt. Coal is expected to add $300 million in annualized revenue with a $20 million in additional EBITDA. This puts the company's acquisition price about 9.5 times EBITDA, which is above Mullen's own valuation, actually. So they bought it at a premium compared to their own company. Now, shifting to the balance sheet, with the acquisition closing, we're looking at a net debt position and including leases about $1 billion, without leases $788 million, putting the company's leverage about 3 times net debt to EBITDA, including leases 2.4 times without. As well, the company did shift that floating rate bank debt, the line of credit, to a private placed note, and that note's at 6.1%. They paid off the line of credit as well as they rolled some debt that was maturing. I'd prefer generally when you're looking at these long-term, especially a macroeconomically sensitive business, to have that fixed interest rate so you don't have to deal with that side of the business. So overall, they've reduced interest rate risk by shifting the debt from the line of credit to the long-term debt. But overall, the company is more levered than previously, but it's not absurdly over-leveraged by any means. The company has as well been able to consistently buy back shares in addition to its dividends, which has consistently dropped the share count since 2020. You can see that nice sloping down of the share count, which we do like to see. That's good shareholder returns. And that's how you know it's consistent about just by purely looking at a graph. It's sometimes you will see how some companies do a substantial course issuer bid and you'll see a big drop, but here's normal course issuer bid, which is being repeated over and over again. And that can actually signal good operating cash flow and good cash flow in general. As well, they are a dividend grower, but I will note they did previously actually suspend the dividend like many other companies during COVID. And it took a couple years to grow back to those pre-COVID figures. And you see that quite a few companies, especially since online, Yahoo, Seek Alpha, and so on, they'll pull the last 5 years of growth. You do need to be wary about that. I'm going to highlight that now because we're hitting that 5-year mark. I know it seems like it was yesterday, COVID, but we're at the 5-year mark. So if you are looking at these dividend growth companies, look at pre-COVID and post-COVID. I just want to highlight that here, but they have been a generally consistent grower, barring that periods of flat, though, but long-term growth since they really shifted into their more modern form. The payout ratio is about 25% operating cash flow, which is sustainable in the current cash flow and debt rate, but it's not a ton of room for growth either. You're not going to see them suddenly do 10 cents every month. This is 7. But it is a bit of room for growth if they are able to grow the cash flows like they are looking to going forward, given the current rate of interest, debt repayments, CapEx, and so on. Shifting to valuations, the company is slightly cheaper currently, but not overly cheap. It's not a massive discount, but it's not expensive either. I would say a slight discount is qualitatively where I'd put it. Given the current non-existent organic growth in the current environment, it is macroeconomic sensitivity. That is just something you have to accept within the industry. The company is trading at a forward EV/EBITDA of 6.7 times based on analyst consensus, and that's an EBITDA of $332 million, which is below management's initial guidance of $350 million. But management did note in the last conference call that they are trading behind due to the delayed acquisition and the trade situation. And they noted 325 to 330 for comparable operations. That'd be without calls for what they're looking. So the analyst expectations seem to be pretty in line with what's going on right now. And on a forward price earnings basis, we're looking at 11.9 times forward off analyst consensus as well. To summarize, the company is just not seeing organic growth for 2025. There's compressed margins due to cost and competitive environment. And the Kohl's acquisition is really the star of the show for the year. It adds some growth to the company. They are an acquisitive company. They have been over time. And you can see the dozens of acquisitions or subsidiaries that they have under different brands. And it's what they do best. And that's what's been adding growth in the long term. But you should expect a GDP level growth for this type of industry. And when GDP goes bad, like we saw go negative in Canada during this last quarter, it's going to struggle. It's going to be flat. It's going to be slightly down. And that's what we're seeing here. The company has good shareholders return with 6.1% dividend yield, in addition to the buybacks at a reasonable payout ratio. That is good to see. And that's something which you really want to track going forward is can they cover both their acquisitions as well as their dividends and the buybacks. Normally the buybacks are the first goal, which is what you would expect. So mainly covering the dividend. Then where's the upside from there? Valuation, I would say, is a slight discount at this time, but it's not that unreasonable that there is a discount given the trade situation, the really declining macroeconomic conditions in Canada and the US. It's not surprising. The company is macroeconomic sensitive alongside with the rest of the logistics industry. So volatility, general negative attitude outlook does explain a minor discount. If you were one to look to buy Mullen, or you do already hold it, you're likely going to need to look at least 3 to 5 years out, even longer, as near-term volatility in both the share price and fundamentals will likely be higher. If we do have a big economic collapse, you'll likely see a significant slowdown, which would then in turn hit the share price as well. So for now, KeyStone will continue to monitor the stock.
Yeah, I think it's a really good summary. I think the company trades about the average PE multiple on a forward basis that it has over the past 10 years. I think price to cash flow is a little bit lower, but I mean, part of it is really outside of the acquisition, the lack of organic growth in the business. So, it's a good dividend. If you like the dividend, you're looking 3 to 5 years out, there's a case to be made if, they can start to accelerate some organic growth. But we're not just certain on that at this point, if they can do that in terms of accelerating organic growth.
Yeah, that would be the pivot. I would say, especially switching to that capital light area, you do have a bit more opportunity there, but it's a wait and see for that side of the business for sure.
If we could start to see that, then it gets interesting. If you could start to see that become a bigger part and have some organic growth from that less capital intensive part of the business for sure. So that's why we monitor these companies each year. And if it changes, then it can become a recommendation for our clients. All right, Brennan, anything else you got? Or are we going to close off the show? Okay, keep your questions coming in to our Your Stock, Our Take segment. If you are watching this on YouTube right now, smash that subscribe button. Or if you're listening to it wherever you consume your podcast, rate and review us. And as always, I'd like to wish you profitable investing. Thank you.
Thanks, everyone.
Thank you.